A few weeks ago, a credit rating agency changed one letter grade on one company, and almost nobody outside financial media noticed. That's usually how it goes with credit downgrades, a quiet event in a quiet corner of the market, the kind of thing that shows up as a small headline and nothing else. This one's different, and not because of who got downgraded. Oracle has been downgraded before. It's different because of why. S&P didn't cite a bad quarter, a lawsuit, or a management shakeup. It cited the AI buildout itself, the exact vendor financing and off-balance sheet machinery this show spent an entire episode building from scratch in a previous AI Follow the Money episode. At the time, that episode ended by naming the specific thing that would justify coming back to this material. A stalled mega deal, a downgrade on SPV debt, a lease nobody renews. We said we'd wait for one of those to actually happen before treating this as a live story instead of a standing concern. One of them happened. This episode is about what it actually tells us, and just as importantly, what it doesn't. Here's the part that gets lost in credit rating drops headlines. A downgrade isn't a warning label. It's a trigger. On July 9, 2026, S&P Global Ratings lowered Oracle's corporate credit rating from BBB to BBB-. Footnote 1. One notch. On a rating scale that looks small on paper, AAA down through BBB is investment grade, BB and below is speculative grade, which is the technical term for what everyone else calls junk. One notch doesn't sound dramatic. But BBB- is the last rung before that line. Oracle is now one downgrade away from junk status, something that has never happened in the company's history as a rated issuer. Footnote 2. Why does the letter grade matter enough to trigger anything? Because a huge number of financial contracts are written with credit ratings embedded directly into their terms, not as a suggestion but as an automatic switch. This is the part that actually made news. Wisconsin's Public Service Commission requires data center operators seeking electric service from the utility We Energies to maintain an A rating or better, specifically to protect ratepayers from being left holding the cost if a data center operator goes under mid-project. Footnote 3. Oracle's downgrade dropped it 2 full notches below that threshold. The contract's response wasn't a warning letter, it was automatic. Post collateral in cash or a line of credit covering the gap. The number that resulted? North of $7 billion. Footnote 4. Oracle is now suing the Wisconsin regulator over the requirement, arguing the collateral burden is disproportionate. Footnote 5. S&P's reasoning for the downgrade is worth stating precisely, because it's not vague concern, it's a specific financial trajectory. The agency now projects Oracle's free cash flow deficit will widen to roughly negative $42 billion in fiscal 2027, nearly double what S&P had projected before, driven by capital expenditure that's climbed from $21.2 billion in fiscal 2025 to $55.7 billion in fiscal 2026, with $90 to $95 billion projected for fiscal 2027. Footnote 6. Oracle's total debt load now sits at $167 billion, making it the second largest non-financial corporate debt issuer in the Bloomberg U.S. Corporate Bond Index, trailing only Amazon. Footnote 7. None of that is speculative modeling of some future risk. It's the current, present-tense shape of the balance sheet. In a previous AI episode, this channel established the basic AI financing architecture. Vendor financing, where the chip maker effectively bankrolls its own customer's purchase, and special-purpose vehicles, off-balance sheet entities that let the debt for a data center sit somewhere other than the parent company's own books. Oracle's downgrade is the live stress test of exactly that architecture, and the honest reframe is this. The downgrade wasn't caused by a bad SPV deal going wrong. Standard, on-the-books corporate debt did this. The collateral trigger, the leverage ratio breach, the cash flow projection. The SPV side of the ledger is a separate, larger exposure that hasn't shown its own stress test yet. S&P's single biggest flag wasn't the debt total. It was concentration. OpenAI now accounts for roughly half of Oracle's $638 billion in remaining performance obligations, the contracted future revenue Oracle expects to actually collect. Footnote 8. That figure should sound familiar. In Episode 10, the AI Money Loop, aka the AI Boom's Hidden Debt, Let's Follow the Money, Section 2 already established that OpenAI's own confidential One shows roughly $25 billion in annualized revenue against $80 to $100 billion in annual compute commitments and cumulative forecast losses approaching $115 billion through 2029. Footnote 9. Put those two numbers next to each other and the exposure gets uncomfortably specific. Oracle's credit health is now meaningfully tied to whether a company running 9-figure annual losses can keep making good on contracts worth more than $1/3 trillion. Oracle isn't alone in feeling this. Meta's Hyperion Data Center SPV, the $27 to $30 billion Louisiana structure this show already covered, saw its credit default swap pricing spike sharply in May 2026, months before Oracle's downgrade, a market price signal of rising default risk that arrived well ahead of any formal rating action. Footnote 10. CoreWeave, a smaller and more aggressive player in the same space, financed a $7.5 billion facility using its own GPUs and customer contracts as loan collateral, with repayments beginning in January 2026 just as the resale value of that collateral, used AI chips, began declining. Footnote 11. None of these are Oracle's problems specifically. They're the same financing logic, tested by 3 different companies in 3 different ways in the same 18-month window. Here's the human scale reframe, and it's the part that should actually change how you think about your own exposure. This debt doesn't stay contained to institutional balance sheets. Private credit firms have been packaging exactly this kind of AI infrastructure debt into products sold through mutual funds and retirement account offerings. Footnote 12. If you have a 401k with any meaningful allocation to private credit or alternative fixed income, a category that's grown specifically because it offers yield institutional bond markets don't, there's a real chance some fraction of your retirement savings is now quietly correlated with whether Oracle's data center leases get renewed on schedule. There's a specific reason this concentration risk is worse than it looks on a spreadsheet. A $638 billion backlog sounds like diversified strength. Many contracts spread across time. It isn't in the way that matters. Half of it runs through one counterparty, and that counterparty's own numbers, established last episode, show a company burning roughly $4 of compute commitment for every $1 of current revenue. If OpenAI's fundraising trajectory falters, not fails outright, just slows relative to what $80 to $100 billion in annual compute commitments requires, Oracle doesn't lose a diversified customer base gradually. It loses the anchor tenant for a building it's already built. Data centers are not general-purpose assets in the way an office building is. The specialized cooling, power density, and physical layout built for one hyperscaler's GPU fleet doesn't repurpose cleanly for a different buyer on short notice. That's the mechanism behind S&P's specific worry about Oracle being left with massive data center leases it may struggle to exit or release on favorable terms. It's not a hypothetical. It's a structural feature of the asset itself. For groups could, in principle, put the brakes on this before it gets worse. None of them will, and the reasons are worth walking through quickly because none of them are the same reason. Oracle itself could slow the build-out. It won't because slowing down in a capacity race means ceding contracted customers to Microsoft, Amazon, or Google, and the entire investment thesis, the $638 billion backlog, depends on being the vendor with capacity available when a hyperscale customer needs it. Oracle has instead announced a planned $20 billion equity issuance in 2026 to keep funding expansion, not to reduce it. Footnote 13. Credit rating agencies could sound the alarm earlier and harder. They mostly grade what already happened. S&P's own language when explaining the downgrade, that it had previously underestimated how much cash the AI build-out would consume, is an admission the agency was behind the curve, not ahead of it. Footnote 14, rating agencies are, structurally, a rearview mirror wearing a windshield's reputation. State utility regulators could enforce credit standards uniformly. Wisconsin tried and got sued for it. A single state imposing a strict collateral requirement, while data center operators can simply cite their next project in a state that isn't a break. It's a reason to pick a different state. Bond market discipline, investors simply refusing to buy the debt or demanding punishing yields for the risk, could, in theory, price this correctly and force restraint. So far it hasn't. Oracle raised $18 billion in September 2025 with no trouble finding buyers, weeks after the OpenAI contract was announced, and is now facing a lawsuit from bondholders, led by the Ohio Carpenters Pension Plan, alleging the offering documents understated how much additional debt was already being planned at the time. Footnote 15. The market bought the bonds. The complaint isn't that the market said no. It's that the market may not have been told everything before it said yes. Notice what these four failures have in common, because it's not incompetence in any of them. Oracle is behaving rationally for a company in a capacity race. The rating agency is behaving the way rating agencies structurally behave, reactive by design, since their job is to grade risk that already exists, not forecast risk that hasn't shown up in the numbers yet. Wisconsin's regulator did exactly what a regulator is supposed to do, and got sued for the trouble of doing it first, which is its own quiet lesson about why other states might hesitate to follow. And bond buyers priced the debt based on the information they were given, which is precisely the allegation now in litigation. Every actor optimized for its own incentives correctly. The system-level result is a structure where no single rational decision, made by any single actor, was the mistake, and yet the aggregate outcome is exactly the fragility this show has been describing since episode 10. This is worth being honest about rather than reaching for a new metaphor. This is the same locked room this show already opened back in episode 10, the relocated perimeter where post-2008 reforms pushed risky lending out of regulated banks and simply moved the risk somewhere less visible, not somewhere safer. The difference this episode makes is that the door isn't theoretical anymore. Wisconsin ratepayers, Ohio pension fund bondholders, and, if the retirement product exposure is real, an unknown number of retail savers, are the ones standing in the room right now finding out in real time what relocated actually meant. It's worth being precise about what this episode is and isn't claiming, because the sober version is more useful than the dramatic one. This is not, on its own, a systemic financial crisis. A Federal Reserve Bank of Chicago study from February 2026 found that banks' direct outstanding exposure to AI-adjacent industries averages just 0.8% of total assets. A genuinely small number, even accounting for the study's own caution that indirect exposure, through lending relationships with the private credit funds actually holding this debt, is harder to see and likely larger. Footnote 15. Oracle has not defaulted. It has not missed a payment. It remains, by S&P's own explicit statement, investment grade, with the agency stating it remains optimistic about Oracle's ability to manage costs and raise capital going forward. Footnote 14. This is a company under real financial strain, not a company in crisis. What it is, the first piece of hard, dated, market-verified evidence that the debt this show flagged as invisible in episode 10 is not, in fact, invisible to the parties actually holding it, a state regulator, a pension fund's bondholders, a rating agency revising its own prior estimate. The perimeter didn't fail. It did exactly what it was built to do, keep the risk off Oracle's headline balance sheet, right up until a contractual trigger in a Wisconsin utility tariff made it visible anyway, from a direction almost nobody was watching. The next domino, if there is one, won't look like this one. It'll be a different company, a different trigger, a different regulator or counterparty finding the tripwire nobody flagged in advance. That's not a prediction about timing. It's a description of how a relocated perimeter actually works. You don't find out where the risk went until something on the other side of it moves. Oracle isn't the AI boom collapsing. It's the AI boom's financing architecture getting its first real-world stress test, and it held, expensively, publicly, and with a lawsuit attached, but it held. The number worth remembering isn't $7 billion in collateral. It's that nobody, including S&P, saw the collateral trigger coming until the downgrade made it automatic. There's a much older, much slower version of this same problem. Debt coming due, obligations that don't disappear just because nobody wants to look at them directly. Next episode, this show goes back to the beginning of that story. Not corporate debt with a maturity date, but a bill with 71 million people's names already on it, and a due date the government itself just moved a year closer.